It's another edition of the Trading Tips video newsletter, teaching you how to become a successful trader in less than 5 minutes per week. The video newsletter is brought to you by TradingTips.com.
Welcome to this video podcast on market psychology, overcoming the emotions of greed and fear. This podcast will examine how you can use entry prices, price targets, and stop losses to develop a plan for success, using logic instead of emotion to govern your trading strategies. It's said that the stock market is governed by the emotions of greed and fear. The emotion of greed inflates stock prices during a bull market. This is when the little investors decide to get into the market. As a result, these bandwagon investors end up buying at the top and paying higher prices for stocks than they're actually worth. On the other side, fear depresses stock prices during busts. This is when the smart money takes profits. By allowing their trades to be ruled by their emotions, little investors tend to buy high on greed and sell low on fear. But there are two sides of every trade. Just as being ruled by the emotions of greed and fear is a sure losing market psychology, there's also a winning market psychology. The smart money, that is, professional investors, buy low and sell high. They do this by using logic to overcome their emotions. How do you overcome your emotions? You have to have a plan, and you have to stick to it. That plan should consist of an entry price, target price or prices, and a stop loss for every stock you buy or short sell. First, let's look at entry price. This is the price at which you want to buy or short a stock. In most cases, you'll want to use what's called a limit order. A limit order, in contrast to a market order, which is filled immediately at whatever price the stock is currently trading, allows you to make a standing order to buy a stock at or below the designated price, or in the case of a short sale, sell the stock at or above the given price. Limit orders can be triggered automatically. Here's an example of how to place a limit buy order with a popular online broker. I've selected limit instead of market, stop, stop limit, or market on close. Notice there's a space for me to put the maximum price I'm willing to pay for this stock, the limit buy order price. What if the stock makes it the whole day without ever hitting its entry price? Well, it depends on if you enter a day order or a GTC, which stands for good till canceled. Day orders are limit orders that expire at the end of the day. GTC orders are, of course, good until canceled. Now, there are some times when a limit order may not be appropriate for your entry price. For example, some technical analysts like to buy a stock only after it's surpassed a certain price, or short sell a stock only once it's fallen below a given price. In these cases, market orders or more advanced techniques should be employed. Here's a quick screenshot example of how you can place a day order or a GTC good till canceled order. It's easy. There are three elements to our plan for overcoming greed and fear: entry price, target price or prices, and stop loss. Next on the list is the target price. This is the price at which you plan to sell or cover your position, or at least a portion of your position, and you must stick to this plan. For example, let's say I buy 100 shares of XYZ at $29. I decide I need to make a 7.5% profit, so that means my first target price is going to be $31.18. My plan is to sell half my position, or 50 shares, once the stock reaches $31.18. I will hold on to the other 50 shares until I realize a 12% profit, or $32.48. Now, the important thing is that I stick to this plan. If the stock quickly reaches $31.18 and I decide to hold on a little longer to make a bigger profit, I'll be letting the emotion of greed take over, and this is a sure recipe for losses. Setting price targets takes the emotion out of investing. You can be cool and logical, but only if you stick to your plan. On the other side of things, there's the stop loss. This is the price at which you will sell or cover your stocks if they go south. For example, I might decide that I cannot afford to lose more than 8% on XYZ, so I'd set my stop loss price at $26.68. A stop loss, by the way, can be entered as part of your opening transaction, and thus it can be automatically triggered just like a limit order. This is very important because the biggest way little investors lose money is by holding on to losers, thinking they'll bounce back. This is an example of greed. Do not let this emotion or any emotional attachment to your stocks govern your trading. Here we have an example of how to place a stop or stop limit order. To recap, the way to overcome the emotions of greed and fear is to plan ahead and stick to your plan. Your plan should include an entry price, a price target or targets, and a stop loss. We hope you've enjoyed this podcast on market psychology.
Do you want to view more Trading Tips videos? Visit tradingtips.com. Sign up for our free video newsletters. Become a successful trader by visiting tradingtips.com.